Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again, fresh from a US Payrolls report, is Pepperstone Senior Market Strategist Michael Brown. Hello, Michael.
Very good afternoon to you, mate. The sun is shining in London once more, and as you said, Payrolls Thursday today. The US closed for Independence Day tomorrow, so we're getting that a day earlier than usual, but a very solid report regardless of what day it's issued.
No, absolutely. I didn't see much wrong with that, which I think was a little bit surprising given the weak ADP report we saw earlier this week. But we'll get into that shortly, because I think it's important to state up front that a week ago we talked about the fact that we were going to do a review of 2025. What's done well, what hasn't done well, the good, the bad and the ugly, if you like. And no, we're not the ugly. And before anyone
I've already
goes
made that joke, don't worry.
Before anyone goes there. But I think obviously with the US finishing early with respect to 4th of July, I thought, you probably thought that, we were going to have a fairly quiet week of it, podcast-wise. Nothing could be further from the truth, given the events of the last 24 to 48 hours, particularly here in the UK. What happened at Westminster yesterday? Can't ignore that. The effect that had, Rachel Reeves' tears, had on bond markets and the currency markets in general, as we come up to the 1-year anniversary of the Labour Party winning last year's general election. So I think, in terms of symbology or imagery, I think Rachel Reeves' tears could also be emblematic of how we feel after a year of a Labour government, perhaps. That aside, I think you'd had to have a heart of stone, I think, not to sort of feel a little bit uncomfortable with what was going on. So we're going to talk about that. We're going to talk about the latest US jobs data, and then we'll move on to the news that AstraZeneca could be looking to relocate to the US, and then we'll obviously go on to the review of 2025, what's coming next, the weaker US dollar, the worst first half since the 1970s, what's behind that, potential targets for stock markets and currencies in general, as well as looking at this week's earnings announcements from Sainsbury's. Pretty decent, Currys pretty decent, Greggs not so much. And then looking ahead to a fairly light week next week. Fed minutes are probably the only item of real note to really get your chops round. So before we get into all of that, get on to the risk warning. Without further ado, I will start on that. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 7% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay.
Where do we begin?
Let's get started. Tempted to say the tears of a clown, but I think that would be cruel. For all her faults, Rachel Reeves is still a human being. It's always very uncomfortable, I think, when you see someone who's in obvious signs of distress. But nonetheless, I think whatever was behind those tears, I think knowing she'd have the eyes of the UK and potentially the financial markets on her, given her position, maybe it wasn't the wisest decision to basically go into the House of Commons in that in that emotional state, because of the symbolism, the optics, and everything else. So don't get me wrong, I don't think she's up to the job. I think she's ill suited to it, but ultimately, financial markets politics is all about optics, and those optics were terrible.
Yeah, I fully agree. I think, you can argue, and there were these arguments taking place on social media on Wednesday around, we should, be feeling sorry or whatever. Well, okay, maybe, but frankly, financial markets do not have emotions, and they do not care about anyone's emotions. And I think, this is just emblematic and another example of how unsustainable the situation is with the government's fiscal stewardship of the economy. Not only do we have on the front page of the Financial Times this morning a picture of our Chancellor crying in the House of Commons, which is not exactly a reassuring message to send to international investors or even domestic investors for that matter. We've got gilts swinging around all over the place. The 30-year yield was up by as much as 20 basis points yesterday, and then we've rallied and paired about half of that move today. And I think for me, that is really the problem here, is that we have a government that has been for some time, and it's becoming more and more obvious that they are simply beholden to what's going on in financial markets. And it is gilt traders that really hold the power over Rachel Reeves and Keir Starmer at this moment in time. And it is an untenable situation where the Treasury are spending the majority of their day paranoid about where the next tick in gilt yields is going to go. That is not a foundation on which you can build any sort of strong or stable economy, as they continue spouting on about. But the one thing I would say is that all of this sort of soap opera over the last 24 hours or so is probably Rachel Reeves' best argument for actually staying in the job. And the reason I say that is because the market's calculus yesterday was, is she on her way out? Possibly. If she is ditched or decides to walk or whatever it may be, who replaces her? Probably someone much more left-wing, given the names that are being thrown around. What do? They probably tear up the fiscal rules and rewrite them, which leads to much higher borrowing costs. So actually, I'm in agreement with you that Rachel Reeves, I think she's doing an utterly terrible job. But for markets, I think it's almost a case of better the devil you know, because whoever replaces her could well be 10 times worse.
Yeah. Be careful what you wish for, basically. Yeah. But I think, she's been politically weakened. They're both politically weakened, the pair of them. And I think, irrespective of how I feel about Rachel Reeves, I think Keir Starmer's behaviour was even worse, to not even realise what was going on behind him.
Yeah, that's
with one of his key front bench members, and to protect her, essentially. From, we've all been in situations where we're emotionally fragile, whether it be at work or whether it be at home. I mean, I've been on a trading floor and everything I touch has gone to, I was about to say a four-letter word beginning with S
on the podcast.
then, but where I felt the walls were closing in on me. But you have to basically either plough through or cut your losses and step away, not basically go straight back in and stay in the financial glare, or the glare of those headlights of scrutiny. And sometimes you need to take a step back. But on your point about the Labour Party or the government is beholden to financial markets, they're not. I would disagree with that. We've got a classic case here of the tail wagging the dog. Essentially, they're backbenchers. Are essentially a driving policy here. I saw a quote earlier this week after the welfare climb down. One Labour MP was heard saying, "I don't understand why this means tax rises when it's only a few £billion." Well, if you don't understand that, you have no business being an MP. And maybe if you spent less time on political activism and more time learning about financial literacy, you would understand, you absolute tool. And I think this is the problem. We have a whole cohort of MPs who spent their time not basically learning about economics, not learning about how running a business, more interested in political activism and less interested about the inner workings of how an economy works.
No, I think you're absolutely right. Very well said indeed. And frankly, I was as shocked as you were to read that quote. And I think, again, we're basically in a situation where the government is unable to govern, because that welfare bill, which was sort of the trigger for all of this on Tuesday, the aim was to cut £5 billion, and they've actually ended up increasing spending by 0.1 billion on net by the end of 2029. So Rachel Reeves wakes up on Tuesday morning and goes, "We're going to cut spending today," to bed on Tuesday night, and has actually increased it. And that's all driven by this backbench rebellion that they were trying to head off. So I think, frankly, she is still on borrowed time. I said this back in March, I think, after the spring statement. Nothing has changed on that front, to quote Theresa May. Nothing has changed. She is going to be shuffled out at some point, and I think it remains a case of the only question being when, and the answer is when it is most politically expedient for Keir Starmer to do so. That moment is not right now, but at some point the proverbial bus that she will be thrown under will come along, and I think it's a matter of when rather than if that happens.
And the problem with that, though, I think, Michael, is if Rachel Reeves goes under that bus, I don't think Keir Starmer will be too far behind her. And then really it's a case, really I think it's just a question of adopting the brace position, particularly in gilt markets and currency markets, because I think if the bond market starts to lose faith in the financial stewardship of the UK economy, then things could get ugly very, very quickly. And financial reality is likely to hit this government like a runaway train. Yeah.
No, I fully agree. We could, of course, rant about the government all day, but we do have quite a lot to get through, so shall we move on?
Yeah, let's move on. Obviously, we also had news this week that AstraZeneca could be I think an awful lot of this is potential hearsay. That CEO Pascal Soriot is exploring the idea of moving the primary listing of one of the UK's biggest corporates to the US. 7% of the 7.1% I think is the weighting on the FTSE 100. It's a
Yeah.
big component for UK dividends, but it's also a big UK employer. But in some ways, I don't blame him, given the farrago that we heard, or they had to endure earlier, I think, late last year, with respect to the Speak factory, which they pulled out of, Speak in Liverpool. I think it's. I don't think it's. I think it's very difficult not to overstate how potentially toxic that would be for the UK, and could potentially mean that further companies may well follow.
Yeah, I think you're absolutely right. And, there's a few things that stand out with this one. AstraZeneca are, depending on where prices are at any given moment, either the first, second or third biggest stock in the FTSE 100. Them, HSBC and Shell sort of rotate that honour among themselves. But to your last point there, if you're a London-listed company, no matter how big that company is, and you're sat there going, well, the biggest fish in this pond is potentially going to leave and go somewhere else, there is almost next to no barrier to stop you doing the same thing. You're going to be sat there going, well, if it's good enough for them and they're the biggest company in the market and they're worried, then surely I should be thinking along similar lines. The other thing that concerned me, and we actually spoke about this on WhatsApp on Tuesday when the news broke, is this is not a case of AstraZeneca seeking a better valuation. So like we've seen with a number of other companies going, we will be better valued in the US. That's not a complaint that AstraZeneca have. The issue here is effectively, as you alluded to, the CEO has just got fed up with operating in the UK. And I would argue that's almost a bigger issue, because surely that's common among most business owners and CEOs, you would expect. And it's also something that doesn't seem like it's, in terms of the government and the political environment, it doesn't seem like that is going to improve anytime soon, at least not in the next 4 years or so. So you've now almost got two catalysts driving people to the exit. The first being the lack of liquidity and the relatively low valuations on offer in London, and the second being just a general annoyance with the operating environment in the UK. And I think if AstraZeneca do leave the London market, then you're almost at the point where the floodgates will open and the last one out just needs to remember to turn the light off.
Yeah, I mean, Shell's already been talking about it, and obviously they're up there as well.
Mm-hmm.
In terms of the risk of leaving the London market, and between the two of them, they make up around about 15% of the overall market cap of the FTSE 100. And the other companies, as you say, HSBC, GSK, Unilever, BP, Rolls-Royce, and BAE Systems, who make up collectively 45% of the total market cap of the index. So, it's important that we don't, underestimate the impact that AstraZeneca leaving would have. And the fact is, they do 40% of their sales in the US. So the reasons for leaving are quite compelling, even though they are valued at a much higher valuation than their nearest competitor, Pfizer, in the US.
And also, you say Shell, as we know, there's been talk on that front. SBC, there's always the risk that they're going to pivot back to Asia and move the primary listing to Hong Kong. Yeah, that's almost a quarter of the FTSE market cap gone in three stocks, if that happens. I would hope, and I said this in a note earlier in the week, I would hope that Darren Jones, the number 2 at the Treasury, or Johnny Reynolds, the business secretary, jumped straight on the phone to Soriot and gone, what are your concerns, mate? Let's try and sort them out. But I certainly won't hold my breath for news of that phone call taking place.
Well, if they were that concerned about it, maybe they should have given AstraZeneca the extra 50 million quid that they asked for to keep the Speak place, to get the investment in the Speak operation in Liverpool.
Yeah,
but it suggests to me that this.
Yeah,
exactly. I mean, it's a fairly low price to pay, isn't it? 50 million quid, and AstraZeneca basically invests. I mean, the UK is such an important hub, I think, when it comes to pharmaceuticals.
Absolutely.
We've got a fairly strong sector there, and they make up a big proportion of a significant proportion of the UK jobs market.
Yeah, and we need to do our absolute utmost in order to try and hang on to that.
And encourage investment in it. Unfortunately, this government shows no indication of either understanding that or doing anything to address it. Anyway.
We've started ranting again, haven't we?
We have, we have. Okay, so let's talk payrolls. Fairly
Yes.
decent set of June payroll numbers. I was listening to your podcast earlier today with Ryan on Peak,
No,
or your
nowhere near
morning,
as good as this podcast,
your
but
your your morning blast. And well, the thing is, you see, you get to rant every day on that, whereas it's only once a week here. So, but I think Ryan made some fairly, I think, decent points on non-farm payrolls, and I think made mention of people's skepticism about ADP. So the floor is yours, Michael. And which is the more accurate, non-farm or ADP? What do they tell us about the US economy? And do they justify President Trump's calls for a 300 basis point rate cut? Discuss.
well, let's get the last one out of the way first, because the answer is a resounding no. For anyone unaware, the June non-farm payrolls number, which was released today, pointed to 147,000 jobs having been added to the US economy last month. You can't add 150 odd thousand jobs and then say we need to lower rates by 3 percentage points. That's just
Yeah, but what does ADP
nonsense.
show?
Well, that's where I was coming on to, because the ADP number, that was actually minus 33,000 a little bit earlier in the week. Now, there are a few distinctions between the two data sets, the main one being that the ADP employment survey, that only measures private employment, so it doesn't account for anything in the government sector. Now, as to the question of which is more accurate, I think there's question marks over both. The ADP number, if you plot that on a chart, it sort of moves around like a yo-yo. There doesn't actually seem to be any sort of trend in the data. It's all very noisy. And then if you look at the NFP print, it is very frequently revised, just in terms of the net revision that we get every time the data is released, but also the benchmark revision that takes place twice a year. And as you were saying, was it 1.6 million that was revised out of the payrolls print over the last year or so? I can't remember the stat you threw at me earlier now.
It was
You can't remember
100.
it
No, it was basically 165.
Ah, there we go. Perfect.
165,000 year to date. Year to date.
And we've only had 6 prints
Yeah.
so far. So yeah,
Well, five revisions.
5 revisions, of course. So both have their drawbacks, for want of a better word. I think that the key way that I would sort of frame this is it depends what you're using the data for. If you're using the data as a short-term trader speculating on the market, obviously you're going to pay much more attention to the NFP print, because that is the big market movement, not as much as it used to be, but it is still the main event of the month in terms of scheduled data releases. And if you are a short-term trader, you're going to be going, I want to try and use ADP to get a steer on what the NFP number may look like, so I'm positioned appropriately for that on the front. If you are a longer-term investor, or if you're a strategist or an economist, whatever you may be, then it is very much an open question as to which you would rather rely on, because what you're trying to do is build a sort of longer-running story of what the US economy is doing, as opposed to where the next number is going to be. And in that respect, I think the correct approach would be to encompass a range of indicators, not just ADP and NFP, but also things like the PMI surveys, look at the JOLTS numbers. We had a big beat on job openings earlier in the week. If you are in that environment, you're not...
Claims.
And jobless claims, of course. If you're in that sort of role, you're not tying yourself down to one number. What you're actually doing is trying to sort of build a more holistic picture. So I guess to boil that down, they're both as bad as each other. Let's put it that way.
I think that's fair. I think that sometimes there's this tendency to basically unfairly criticise ADP when everybody knows it's at private payrolls, and ADP is a private payrolls firm. So they can only basically process the data that they get and the firms that they process payrolls data for. That's the whole point of it. It's ADP. Non-farms, on the other hand, the revisions, as we talked about earlier, in March, the March payrolls number was 228,000. It was a bumper number, but that has been revised down to 120,000. So that's 108,000 revision down.
Yeah,
just
exactly.
in March. So how accurate is it really? Employment rate fell to 4.1. Average earnings fell as well. So there are signs there of slowing inflationary pressures. And the participation rate jumped up again after slipping back in the previous month. So overall, what we're seeing, I think, in terms of the US economy is, yes, it's slowing, but it's not falling off a cliff. It's very difficult to the president say on the one hand, look, great jobs report, blah, 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 blah. Oh, but we need a 300 basis point rate cut. So the only reason for doing a 300 basis point rate cut is if the economy is falling off a cliff, like what happened during COVID and the financial crisis. Otherwise,
Yep.
what signal does that send from the central bank that they feel it's necessary to do that?
You're absolutely spot on with that one. And I think the other point, sorry, just lastly on the ADP, it's important to stress actually that ADP themselves say that their data is not trying to predict NFP. They phrase it as a sort of alternative gauge of the labour market. So just bear that one in mind. But in terms of the employment situation in the US, the other thing to consider is, clearly things are slowing. They're not crashing, they're just slowing gradually. I think the key thing to consider is why are they slowing? And the reason for that is quite clearly the uncertainty as a result of President Trump's trade and tariff policies. Now, if you then take that one step further and go, okay, well, let's say there is a rate cut, 25 basis points, 50 basis points, whatever it may be. Is that suddenly going to give a massive jolt to the labour market and see things considerably improve? Of course it's not. Because unless that uncertainty goes away, the labour market is going to remain in this sort of inertia of relatively slow hiring and relatively slow firing. And until the uncertainty is alleviated, which can only come from the Oval Office, until that happens, we are just going to remain in this current situation.
And there's another thing. I mean, emergency rate cuts are reactive.
Mm.
So they're not going to have an effect in the short term or even the medium term for that factor. I mean, the whole point of those sorts of rate cuts is they're responding to a potential black swan or an emergency, neither of which I think the US economy is susceptible to at the moment. In fact, the only concerns I have about the US economy is the unpredictability of future policy of the current administration.
Yeah, I completely agree with you. And I think the other thing is, why does Trump want a rate cut? Well, the reason Trump wants a rate cut is, of course, because he thinks that will mean Treasury yields come lower, and it means that borrowing costs for the United States will come lower. The problem is, and I think we've discussed this before, it will have the opposite effect. Because if you bring the Fed funds rate lower from, say, 4.5% to 2.5%, all that is going to do is result in markets becoming much less confident that inflation is going to remain anchored at the 2% target. It's also going to, in this environment, lead to even more concern about the erosion of Fed policy. So what's it going to do to long-end yields? It's going to send them higher. So, Trump can rant and rave and beg as much as he wants for this rate cut, and he can get all his surrogates on social media to do it as well. But frankly, it's going to have the opposite of the desired effect. And if that happened, it would really blow his mind, wouldn't it?
Well, I mean, you would think he would have learnt from the experience of the current Labour government here in the UK. The Bank of England has cut rates consistently since August. And you look at gilt yields, and in some cases, they're actually higher than they were before they started cutting rates. So rate cuts, even of themselves, do not mean higher borrowing costs on government bills and bonds and treasuries.
Yeah, exactly that. But again, we've got into the weeds on Fed independence again.
Yeah. Anyway, okay, so I mean, we've gone through all of that. So hopefully that will neatly bring us on to a much more positive story in terms of how equity markets have performed over the course of the past 6 months. And by and large, it's been a fairly positive story if you forget the first 2 weeks of April.
Yeah, you're absolutely right. It has, if you can wipe that from your minds, which I don't think anyone's going to be able to do for a long time.
No.
Yeah, it's been a very positive 6 months. The S&P is trading at record highs as we speak. We've got the DAX in Germany up 20-odd%. Asia stocks have torn higher. Yeah, the bull market is still raging.
Yeah, I mean, obviously, I think the only index that hasn't made a new record high, obviously aside from the CAC 40, and we'll talk about that a little bit. I mean, it's the FTSE 100. We've seen the DAX make new record highs. I remember saying to you, I think in the aftermath of the April sell-off, I think we've seen the highs for this year for US markets. I couldn't have been more wrong about that, and I'm perfectly prepared to hold my hands up to that. But I think a large part of that was down to the fact that bond markets decided to impose their own type of fiscal discipline on Trump, because I don't think we would have seen the reverse ferret that we got without the reaction of US bond markets. And because he didn't seem to be reacting to the declines we were seeing in US stock markets, it was the bond market that prompted this July the 9th deadline. Obviously, that's looming large now. It's less than a week away. Does that get extended?
Yes. The whole taco thing will come into it once again.
Yeah.
I think it's quite telling that the language over the last week or so has shifted from trade deals to memoranda of understanding and agreements and frameworks and all this sort of thing. I think
So
it's very much
China, Vietnam, UK.
it's very much laying the groundwork for someone to turn around and go, we've got a framework to negotiate further. It's enough that Trump can dress it up as a deal, which means we can kick the can down the road on tariffs once again. But just going back to your point around April, I think absolutely spot on. It was that really aggressive sell-off at the long end of the curve, particularly in the 30-year, which rose north of 5%. I think that's what drove it. Primarily, it was that, and by extension, the sell-off in treasuries causing markets and companies to get a little bit jittery and market function to be slightly impaired. I think that is what drove the pivot from the Trump administration. And since then, they've demonstrated no willingness whatsoever to return to those sort of tariff levels. You look at the deal that they've done with China. Where we've gone from 140% tariffs now down to 30, I think it's pretty clear that there's no desire or even ability to stomach tariffs that are basically amounting to a trade embargo. And I think just on that, the news we had yesterday on the Vietnam deal that you mentioned, it was interesting because this almost tells us what the ceiling is in terms of tariffs, where we knew the floor, that's 10%, that's the baseline levy that's in place. The ceiling, I think, is probably this 40% tariff that they've imposed on trans shipments through Vietnam. So you're now
you're going to have to explain what that means.
Yeah, well, what that effectively means is one of the big concerns, and it's a valid concern, is effectively loopholes that mean people can circumvent the tariffs. So, for example, the Trump administration have done a deal with Vietnam, which means imports from Vietnam into the US, they are subject to a 20% tariff. Now, if you're a manufacturer in Cambodia or in China or Thailand or another country in Asia, and your country is subject to, say, a 70% tariff, what you could do is put your widgets or whatever you've made on a lorry, drive them to Vietnam, and then send them in a boat from Vietnam through to the United States, because then they'd be subject to a 20% tariff. So effectively getting round that tariff that you're supposed to be paying. So the reason this transshipment tariff has been put in place is basically to stop people from doing that. And actually, in Trump's mind and in the administration's mind, make sure they pay the tariff that they're supposed to be paying.
So essentially, what companies are looking to do is basically using Vietnam as a transit country to basically avoid US tariffs. So Trump has said that if they do that, they pay 40.
Yeah, exactly that.
Cool. Okay. I can't see how that's going to work unless you obviously sign up with separate deals with those aforementioned countries like Cambodia and what have you, like Vietnam.
I'm not saying they've thought it through. I'm just saying that's what it's meant to be on paper. Whether it actually turns out to be that in practice is anyone's guess, I suppose.
Oh, I really can't see how that's going to work. Anyway, let's move back on to the FTSE 100. And I think one of the things that I took away, I think we talked about this at the end of last year, is whether or not we could hit 9,000 on the FTSE. We got pretty close, but we haven't quite got there yet. And I think obviously April had a large part to play in that. Mm-hmm. Because I think if April hadn't happened, I think we probably would have got there. I think the bigger question now, given what's happening, not only in the US with the big, beautiful bill, I hate that term. I mean, honestly, really?
I hate it as well, but thankfully the Senate parliamentarian has decided that can't actually be the official name of the bill. So there is some rationality left in the world.
Yeah, indeed. And obviously the political and the fiscal situation here in the UK. Can we hit it can we hit 9,000 in the second half of the year? I would suggest that we probably can. Momentum is still in our favour, but I think in those contexts, I think it's important to look at what's done well.
Yeah, I was also just going to say I agree with your call for 9,000, although I fear neither of us are really putting our neck on the line with that one because we're about 2% away from it at the time of recording.
Yeah, I
so
think when I made the original call, when I made the original call, though, we were well away from it.
Oh, absolutely. So, you were a bit braver with that one than with this one.
Yeah, but I mean it's still my target, and a target is a target. Whether we got to 8,900, we were below 8,400 at the time I made that call, and I think we were around about 8,000. So it's still a sizable move.
Oh, no, absolutely.
And I'm actually surprised that we didn't make it. But looking at what's done well, when you sent me that list through, I was struck by the fact that there was very much a common theme there. Obviously, we had Babcock's, which is up over 129%. Fresnilo, which is a mix
at length.
absolutely, which is a Mexican gold and silver miner. Well, not surprising when gold is up at record highs, and silver now appears to have got a threshold, a floor above $30. I mean, I can remember when silver was trading at $50 about 13 years ago, and everyone was talking about it going to the moon, and it went all the way down to $20. You know, silver's still got quite a way to go to play catch up, but nonetheless, it's done really well. Then you've got Rolls-Royce. You've got BAE Systems. Again, we've talked about them both in the context of the defence story. You know, they've done very well. And then you've got financials. So Lloyd's Banking Group, for example, up 40%. I still think there's potential for further upside there. Despite all the doom and gloom about the UK economy, I still think, you know, there's potential for further upside in banks. NatWest is up 25% year to date as of the 30th of June. I think there's been a couple of days of quite big declines in that.
I was going to say they've had a bit of a wobble recently, haven't they?
They've had a bit of a wobble recently, but I don't think that's overly surprising given where they come from. And I think an awful lot of that has been over optimism that the fact it's finally out from the yoke of government ownership. I think they are now fully private again.
They are.
If I'm correct in that. And obviously Barclays. And then you've got other financials like Aviva, St James's Place, Phoenix Group Holdings, Prudential, you know, all in the top 20 and all showing gains of in excess of 20-25% year to date. There's a theme there, financials and defence, and one retailer in there, strangely enough, Next. And obviously we've talked about that at length on the podcast. When you look at the winners, there's not too much of a surprise there. But when you look at the losers, I am surprised because you've got the mining sector. Copper prices have been fairly strong this year, and yet mining sector don't want to know. Now, I know the answer to this question, but I'm going to pose it to you. Why have miners done so poorly?
Oh, I was hoping you'd bring me into that discussion at some point. Yeah, as we were discussing earlier, and this word keeps coming up, it goes back to tariffs. Yeah, we've got the Trump administration throwing around tariffs on steel and on aluminium. At one point, although everyone seems to have forgotten about it, Howard Lutnick, the Commerce Secretary, was also looking at copper tariffs. That's still a bit of an open question. You know, in short, it's a case of that the share prices of those firms have become detached from their traditional drivers and instead been facing significant headwinds as a result of those ever-changing and uncertain trade policies.
Yeah, Glencore's down 20%. You look at Anglo-American, Rio Tinto, around about down 7 or 8%, 9%, 10%. Retailers, again, JD Sports, and that's down. I mean, it has seen a bit of a recovery recently on the back of a Nike share price bounce, which came about as a result of that Vietnam deal. Because obviously, I think Nike does an awful lot of business out of its supply chain in Asia. So I think a deal there has settled some nerves about Nike, and obviously that's fed into JD Sports. But obviously, you've also got BP, which, despite all the speculation about a takeover, is still very, very weak.
Absolutely. And I think one of the reasons for that weakness is probably because it is purely speculation at this moment in time. A lot of chatter, a lot of rumour, but in terms of concrete progress, there doesn't really seem to have been much. And I think the market's not taking a particularly optimistic view of things there, understandably so.
Yeah, I think... to be honest, I think the BP takeover story, it's good for clicks and what have you. But I think the barriers to a BP being acquired are very, very high indeed. And certainly I think in terms of a company like ExxonMobil, Chevron or a Shell, I think what they could be forced to do is sell off bits and pieces of the business, which may be where Abu Dhabi comes into it. But even there, I still think there's fairly limited upside in terms of an acquisition premium, if you like.
Yeah, I think I'd agree with that.
Marks and Spencer's has had a pretty poor first half, but I don't think we can look too far to understand why that's happened. No, obviously, the cyber attack has weighed on that. That would suggest to me that now they're on the recovery trail for that, we could start to see a rebound in the share price there over the course of the next few.
Also, just on that, actually, sorry to cut you off at the end there. We all know the reasons for it. Sorry, I somehow muted myself there.
You did.
I was saying, Marks and Spencer's, despite all of the stuff with the cyber attack, they are only down 6% year to date. It's not a sort of calamitous crash or anything that they've undergone there. And as you say, now that seems to be in the rear view window, certainly the shops seem a lot better stocked than they have done in the last couple of months. Onwards and upwards, you would hope.
You would think so. I mean, I'm certainly more optimistic about Marks and Spencers, given the extent of the share price decline that we've seen so far this year. If anything, I think the decline was fairly orderly. I don't think there was any underlying concern, and they've been fairly upfront about how much it's going to cost the business over the course of the next 12 to 18 months. And essentially, they've said that the current fiscal year is a write-off, but going forward, they still remain on target when it comes to the profit, revenue, and cash flow goals. So for me, as long as the UK economy holds up, there's no reason why turnaround story can't continue.
No, and it's one of those where you never like or want to see a company go through this sort of thing. But as these events go, I think M&S have actually handled it in pretty good fashion.
Yeah. I mean, these things are never nice, and ultimately there will be some disruption. And certain companies will have benefited from the disruption at M&S. And I'll talk about Sainsbury's in a minute. But I mean, looking at the share price, 350 odd p or wherever it is now, because obviously I'm looking at the chart that you sent me a few days ago, so it's probably slightly dated now. There's no reason, barring any other mishaps, that they can't continue to potentially push on from here. What I did find a little bit surprising was that EasyJet struggled to make any progress in the first half. But then again,
turbulence there maybe.
But then again,
are they going to take off in H2?
Maybe their H2, profits and revenues do tend to take off in H2. It tends to be their stronger quarter that they gain altitude.
Yeah.
Anyway, puns aside.
Well, we best buckle our seatbelts up and get ready for that rally then, I suppose.
Indeed, but I also noticed that IHG, International Hotels Group, was down 15%. Now, obviously, they own chains like Holiday Inn and what have you, and they had a poor first half as well. And so you would think that as the summer season hits, that you might want to see a recovery in that. I'm struggling to understand why they've performed so poorly. So again, they're the bad. The ugly, on the other hand, WPP. I mean, they've had an absolute shocker. The shares are at 5-year lows and revenues are declining, and struggling to understand. Well, I'm not actually struggling to understand why. Traditional, I think, advertising firms, I think, are feeling the effects of AI, and companies like Google, Facebook, and what have you, eating their lunch and struggling to stay relevant.
Yeah, I think you're absolutely spot on, and we know that the advertising industry has been facing some pretty significant headwinds for a number of years now. The incredible advancements that keep being made with AI are only sort of hastening that decline, I suppose. So it's probably no surprise to see them performing so badly. And what's more worrying is you sort of sit there and go, what's the case for a turnaround? Well, I'm struggling to see one, to be frank.
Yeah, and obviously the CEO's going at the end of the year, so I think he's seen the writing on the wall and decided to, I think I'm off.
Yeah, I'll jump before things get even worse.
Yeah. So I think the key thing for WPP, it's got a fairly chunky divvy of about 7%. But the reason the divvy's chunky is because of the share price declines. It's basically pushed up. It's pushed up its dividend yield, so it raises the question of A, whether that dividend yield is sustainable, and B, whether or not they can unlock any value and invest in its own AI tools to take on the likes of Meta and Google and try and reverse that trend in declining earnings. So
it's going to be a very, very tough ask for them, I think.
It is, but I think for me, with the share price at 5-year lows, it's still above the COVID lows. It's still above the lows of about 3 years ago. There's very solid support just below where it is at the moment. If we break below that, then I struggle to make the case. Because I think once investors lose confidence in a business, it's very difficult to get it back. Yeah.
And actually that, without going round and round in circles, that brings us back to Rachel Reeves, where the market has lost confidence in the Chancellor, and she will not get that back very easily at all.
No, indeed. But I think what we can say is it's better the devil you know than the devil you don't. But unfortunately for us, I think that both her and Starmer are irrevocably damaged, and they're in office, but they're not in power.
No.
And I think it's only a matter of time before they get ousted. And if they do, then it's really a question of how long can this government last. Yeah, they've got a 5-year term, but there's a party within a party there. And I think they could collapse under their own contradictions, because ultimately you've got different parts of the party pulling in different directions. And ultimately it will be up to financial markets to impose some sort of fiscal discipline on anyone who replaces Starmer and Reeves.
Yeah,
and that could be very bumpy for asset valuations and asset prices
to say the
going
least.
Forward. If you thought the last 12 months was bad, And Rachel Reeves' tears were emblematic of that.
It might
Buckle
be
up for the
about to
next
get a hell
12
of a lot
months.
worse. Yeah.
It could do. I mean, I don't want to, pour cold water on it, but ultimately you've got to look at the stewardship of the economy at large.
Mm.
And ultimately, while I don't have an awful lot of confidence in Starmer and Reeves, I have even less confidence in what's coming up behind them.
Yeah. No, I fully agree with you on that one.
Okay, so weaker dollar. Worst start to the year since the mid 1970s.
Do you
How
remember that?
much? I would have been about 8.
Sorry.
I was
Dickie
too.
Matthews had just started in the city, I
Yeah,
think, at that point.
I was still at primary school. Still at primary school.
Sorry, mate.
19. Yeah, I know. Right. So, choppiness in yields has obviously been part of it,
Mm.
but it's really not been about borrowing costs, is it? It's been about, does Trump actually want a weaker dollar? I think he's deliberately weakening the dollar. We've always talked about the US having a strong dollar policy. It's always been unsaid, but it's always been the US has a strong dollar policy when everyone knows ultimately that's just a load of old hooey. But Trump, I think, is actively talking the dollar down.
Yeah, and I think you've got to go back to what Treasury Secretary Scott Bessent was saying even before he took the job, actually, towards the back end of last year when he was still a nominee. He effectively outlined the three things that he was aiming for, and they were lower oil prices, lower Treasury yields, and a weaker dollar. So I think, as you say, the public line is that they have a strong dollar policy. I think it's just that they don't want the dollar as strong as it was when they took office. And as you say, they do seem to be pretty proactive in their attempts to talk down the value of the dollar. And of course, the other thing that certainly won't be helping is all of this nonsense around the Fed and various other institutions in the United States, the confidence in which and the independence of them is being eroded very, very rapidly. And that's just seeing institutional and international investors allocate capital elsewhere. Clearly the euro has been a big beneficiary of that, not because there's anything particularly great about the eurozone, but just because it's the sort of largest alternative to the dollar. And also, of course, gold has been a big beneficiary of that as well. And given the Trump administration's current stance and current comments, frankly, it doesn't look like they're going to be changing course anytime soon. So why would the dollar be changing course anytime soon? Why would those capital outflows suddenly turn around and go back the other way?
But at some point, they're going to have to stop. I mean,
At
what we're
some
seeing
point.
here, I think, is a sort of a recalibration, if
Yeah.
you like,
Because
of,
everyone was massively overweight the US, as
yeah.
we know.
And that what we're seeing now is a corrective to that. There's not going to be a run on the dollar, or you'd like to think there wouldn't be, because ultimately, where else would you put your money? A high euro is problematic.
Mm.
There's definitely a pain point there, I think, for the ECB. I think anything over 120 is
Yeah.
going to be problematic for euro dollar.
Well,
And while
I think they've been foolish now. The ECB again, sending your vice president out to do a media round where he says above 120 will be complicated. Well, where do you think the market's now going to take your currency? Don't put that target there. Wave the red rag in front of the bull. Yeah, above 120 is going to be problematic. We know that. We knew that without you telling us. Don't say the quiet part out loud.
because the markets will test that assumption.
Exactly. And you're right. It is going to be an issue for the ECB, and in fact, that's potentially, although again they'll all say they don't target exchange rates, that could potentially be one of the factors that drives them to another rate cut if it were to
Yeah.
be delivered.
I know they've ruled out another rate cut, or certainly some policymakers have. But I would argue if we go above 120, we're going to get one. And it's always the line of least resistance. So what we've seen here is the euro just push up towards 118. It's about 117 and 117 and change at the moment. But I think 120 is pretty much the magnet, and it's going to get there. We may see a few dips on the way, but when I look at my euro dollar chart and I look at the 50-day moving average since March, every test back to that 50-day moving average has held. So for me, we may get a correction back to around 114, 115, but ultimately, as long as that 50-day average holds, the trend is your friend, and we are likely to see 120.
Yeah, very much so.
Same really, I think, applies to cable, though obviously there are some UK government considerations to play when it comes to the strength of the pound. But again, when you look at the 50-day moving average on a cable chart, the trend is pretty much the same. Every single test back to that average since the start of the year has held, which means that we could well see 140 as long as we stay above 134.5. Again, it's about trading the momentum.
Yeah, and I can't even say the word. The momentum is certainly pointing in that direction, and it does seem that those round numbers are the next stop. And it is a case of when we get there, does the market reassess, and equally do policymakers take a closer look at things as well? The Bank of England, outside of Megan Green, don't seem to comment on sterling much, so that could be one to watch there, if they've even worked out what the exchange rate is at this point, which I wouldn't put too much faith in.
Yeah, I mean, people talk about a higher pound being, negative for exports. Certainly, I think there's a case to be made for that. But the flip side of that is it makes imports cheaper and therefore bears down on inflation. So there are always pros and cons, and I just think it's lazy writing and lazy reporting when people focus on the negatives of a higher pound without focusing on the positives. Because essentially, it makes exports more expensive, but it makes your input costs cheaper. So there is always an offset.
Yeah, no, you're spot on.
So basically, that brings me into the next. What do we expect for rate cuts? Well, obviously, no July rate cut from the Fed, given today's payrolls numbers. Bank of England, they've suggested, was it Bailey or someone who suggested that they might be tempted to cut faster if the UK economy slowed markedly?
Yeah, well, let's cover off the Fed first. July it looked ludicrous in my mind. I said it at the time. The market was pricing a 1 in 4 chance that the Fed delivered a cut in July early.
Yeah, it was never going to happen.
Which was never going to happen. And certainly now you've had a Goldilocks jobs report and the equity market trading to new all-time highs. It's definitely not going to happen. The door has been firmly shut on that one. I think there's two sort of scenarios for the Fed. There's a case where inflation remains relatively subdued. The full effect of tariffs, it's not sort of passed through as badly as we would expect, which opens the door to them cutting in September and then potentially again in December, providing that disinflationary trend resumes, or is at least forecast to resume. There's another scenario, which is still my base case, which actually that inflation does show up, and so long as the labour market remains resilient, they will remain in this wait and see mode for a prolonged period of time and probably not cut until December at the earliest. In terms of the BOE, we have had a few speakers. Bailey was sounding a little bit more concerned about the labour market, which I thought was interesting, given his remarks have been squarely focused on inflation recently. We also heard from Alan Taylor, one of the dovish dissenters last time out, who was actually sounding a little bit more hawkish, because he was saying that he expects, or back in May, I should say, he expected it would be appropriate to deliver 5 25 basis point cuts this year. Now, of course, they've already done 2. So is he saying there's only 3 more to come? Is he also saying that he's not going to dissent in favour of any 50 basis point moves? So I think the BOE will cut in August, but the focus there will be on their language. Primarily, do they stick with this gradual and careful approach to easing? Because if they remove or edit that line, that's going to then open the door to a much faster pace of easing in the autumn, which I think is really what they should be doing, given the degree to which the labour market is weakening.
Yeah, we also get an inflation report in August as well, so that's probably a good time to see another rate cut. And it would sort of tie in with the fact that they cut in February and they cut in May and they cut in August every time they do an update to the inflation report. Okay, so that sort of, I think, pretty much takes us up to the preview or the review. So potential continuation, weaker dollar, line of least resistance in terms of stock markets, now that the Nasdaq and the S&P are back above their previous highs, suggests that we could see further gains in the second half of this year. I think in the absence of a significant negative catalyst and the ability of the markets to shrug off negative news, then I think it'd be a very dangerous thing to do and try and pick the top. But having said that, I think it's always a good idea to just play the trend that's in front of you. And at the moment, the trend in front of you, us, is buy the dip.
Yeah, absolutely. And this is something that I spend a lot of time talking about. I'm sure you used to in your previous incarnation.
Still do.
People looking at a market going, well, it's at a record high. It's not going to stay there for long. It's got to come down. Actually, if you go and back test it, the opposite is true. One of the most bullish signs in terms of momentum is, particularly in the equity complex, an index or a stock hitting a new record. That is often one of the best indicators that further gains are going to be on the cards. So I'm fully with you on that one. I think it's very much a case of the bull case is solid. The momentum is certainly with the bulls, and for the time being, it's ride the wave higher and buy dips if we see any.
And if there are any economic shocks, central banks will cut rates, which essentially then reinforces the idea that stocks are probably a better place to be in terms of return. So it's a question of getting your timing right. when you buy, and that is the hardest thing to do, which
Yeah,
is why.
and that's the thing is we all forget because the Fed have been resolute in saying they're in wait and see mode. There's a lot of policy ammunition if they need to deliver it. You know, they've got 450 basis points of room before they get to the lower bound, and they've got as much QE in their toolkit as they want to throw at the market. So, you know, it's very much a case of if there was a shock of some description, which we're not expecting, but you can never rule out, of course. No. You know, central banks have plenty of room to deliver easing and to cushion that blow if they see fit.
And that, you know, that's not being complacent about risks around fiscal sustainability for governments and what have you. But ultimately, you have to put all of that noise aside. It's about what are companies doing?
Yeah, exactly,
not what
that.
Governments are doing. We all know that fiscal sustainability is a hot button issue in the media, but that's a problem for governments. It's less so of a problem for companies.
And we all know that the economies across developed markets are on an unsustainable fiscal trajectory. The problem is that's not something you can trade in the here and now. We will at some point get to a tipping point where the market does focus on that. Primarily fixed income, of course. But, you know, is a worrying path of debt and borrowing a reason to not be invested in the equity market, or worse, to be short the equity market? Right now, absolutely not.
You know, there is a reckoning coming. The problem is there's been a reckoning coming for the last 15 to 20 years.
Yeah, and it could be another 15 to 20 years.
In 20 years. We don't know. You can't time it. All you can do is trade what's in front of you.
Exactly.
And then, and hopefully prepare your portfolio for that.
Yeah, fully agree.
Anyway, we've gone on for quite a bit and we haven't even got on to this week's numbers yet. And broadly, it's been a fairly positive picture. Sainsbury's followed up Tesco's with a broadly positive first quarter update. They briefly popped higher, the shares, to their highest levels since September last year. They've given back a little bit of that over the course of the past couple of days, but they've increased their market share, like Tesco's. They've been helped, I think, since no small part by the cyber attack on Marks and Spencer's, as people migrated away from food offering at M&S and went to Sainsbury's, because fresh food sales on the Taste the Difference range were up 20% during the quarter, which feeds into the idea that an awful lot more people were eating at home because of the warmer weather, barbecues, booze, what have you. And so there was a big boost there. But there was also a significant gain in the Argos division. So, and we talked about that with the B&Q thing and Kingfisher. There was 4.4%, like-for-like sales increased up by 4.7%. So a fairly decent set first quarter numbers. Unfortunately, I think, and this is why the markets sold off a little bit, and they didn't change their guidance like Tesco's.
Yeah, and I think we actually flagged that possibility this time last week.
We did. I think keeping guidance unchanged, for me, is an entirely sensible thing to do. You keep expectations at a fairly steady level rather than raising expectations only to have to cut them later.
Yeah. The issue, of course, is, and we're a fortnight away from earnings season in the US, so we're going to be talking about this a lot, I would imagine. Markets want to see a beat on the figures, but also guidance, positive guidance, upgraded guidance.
But you're not going to get that.
Not in this environment. It's very difficult to.
Yeah, management are always going to be conservative with a small c.
Yeah.
And people will basically take profit, what have you, sell off, and the market will come down again. But overall, there's no reason to suppose they won't meet that guidance. No. The big question is whether or not they fall short of it. And I think we'll get a better idea of that in a few weeks, a few months' time. But having said that, looking at the latest services PMIs out of the UK, they were fairly decent, even though the jobs picture is a little bit concerning because there was job cuts for the ninth month in succession, I think.
Yeah, and also I think the pace of those job cuts increased as well, which is even more worrying considering how rapid they were in May, and then they've quickened again in June. That's very concerning.
Decent set of numbers from Currys as well. Their shares are up 6% today. We talked about that last week on the back of AR World's numbers and the fact that they were fairly decent. Currys have also seen a decent increase in UK revenues of a 4% increase in like-for-like sales again. And these were the full year numbers for last year. So fairly decent set of numbers there. A 1.5p final dividend was also announced. No negative surprises in the guidance, trading in line with further dividends expected over 2025, 2026. The only sour or stale note was Greggs, the bakers. Sausage roll sales slipped because of the hot weather. So their shares were down sharply yesterday and have continued to look a little bit weak today. No surprises there. No one eats sausage rolls when the weather's about 25, 30 degrees, do they?
No, it's not the sort of food you're going to eat in a heat wave. Let's put it that way.
No, no. Unless you had a few beers the night before and you use it to soak up the alcohol, eh, Michael?
No, I've no idea what you're on about. Absolutely none at all. And that wasn't what I bought.
Oh, was it a sausage sandwich? Was it or something different? Oh, right. Okay. Right. Okay, so let's look
There you
ahead
go.
to next.
Come for the market analysis, stay for the hangover cures.
Okay, so basically next week's pretty thin gruel, if I'm honest. Fed minutes, not Bowman and Waller.
Yeah.
They've both come out and suggested that maybe a July rate cut is on the table. Is that political manoeuvring, or do they really believe that? Will these Fed minutes shed any light on that?
Well, I think the importance of the Fed minutes has been diminished significantly on the back of that jobs report. Now that we know a July cut just isn't going to happen, I think the minutes won't really show much by way of that sort of political manoeuvring around a July cut, particularly when you consider that Bowman's call certainly came actually quite a while after that meeting.
It's only a few days.
Yeah, I think it's quite clear that they were politically motivated, we said at the time, and I think they've also now got egg on their faces because, as we discussed earlier on in the podcast, there's literally no reason to be delivering a rate cut in July. So, what will be more interesting is on the 30th or the 31st, whenever it is, do they actually vote for that rate cut? It's all well and good saying that they think it's a good idea in media interviews, but if they actually dissent, then I think that's a bigger issue.
Yeah, but even if they dissent, I would argue that that's politically motivated as well, because
100%.
For me, they're not considered dovish. No. I look at the FOMC and I look at dovish and I look at Austin Goolsbee, who's a Chicago Fed president, and he's not shown himself to be in any way, shape or form inclined to cut rates. He said, inflation's coming down, but I want to see more evidence of that in subsequent reports.
Yeah, absolutely. They're not dovish. They are simply being very flexible with their views and opportunistic in the current political environment. Basically.
They want Powell's job.
Yeah, that's literally all it is. But apart from those minutes, there's not really much going on next week, to be honest, is there?
No, there isn't. I mean, we've got full year numbers from Manchester-based airline Jet2. We've got, I think we may have monthly GDP for May. Am I right in thinking that? Obviously, we saw the April slowdown of minus 0.3. Those services PMIs for recent months.
Yes, sorry, on Friday.
On Friday, on the 11th. Good. So that might, again, they're notoriously volatile, those numbers, so I'm not really sure what we can read into that. And we've also got first quarter numbers from Dr. Martens. Now, as I recall, when they reported their full year numbers, the share price saw a fairly decent increase. And also they said that they weren't going to be affected by tariffs because they'd front run the tariffs by importing an awful lot of their goods previously to the increases. Be interesting to see whether the early year optimism is justified and whether or not, given they've got 1 quarter of trading behind them, whether that guidance will be tweaked upwards or downwards.
Yeah, no, very much so.
We also got Levi Strauss as well, who are sort of in the same boat as Nike when it comes to exposure to tariffs. So again, second quarter numbers from there. So Q1 numbers from Dr. Martens and Levi Strauss. So will the markets give Dr. Martens the boot?
Shall we end the podcast there?
I think we should. And on that bombshell, we'll wind up the podcast. We've gone slightly over the hour, but I'm sure Richard will do his level best to try and get that back under the hour. But it's certainly been illuminating. It's certainly been plenty to talk about. And if you've got any questions, obviously pop a question, X in the tweets, and we'll try and address it in subsequent episodes. But until next week, enjoy your quiet day, because obviously tomorrow, Friday, will be fairly low key. At least it gives you another. Well, it is nice and sunny outside. Maybe you should go out and enjoy the sunshine.
No, I'm
anyway,
going to bed, I think.
Well, that's probably not a bad call. Sleep it off, mate. Anyway, on that note, thanks very much for listening, ladies and gentlemen. We'll see you on the same time, same place next week.
Bye for now.